Well, welcome everybody. Hi, my name's Casey Boland, and I'm with HCM Wealth Advisors and CPAs. I'm joined today by Doug Johnson, who's our Senior Investment Strategist, and Dan Rinck, who is our Research Analyst with HCM Wealth Advisors and CPAs. Welcome to our webinar. If you'd like to ask a question, please go to the bottom of your screen and click on Q&A. And there you'll have an opportunity to submit your question, and we will do our best to answer at the end of our webinar. So, guys, we had kind of a rare occurrence that we've seen here. It's been a strange market couple months. We've got the market has been doing extremely well. You're getting mixed signals from the market, whether it's the gold market, the oil market. We've just seen some really strange combinations. And if you're a sports fan, this is the rare occurrence that we just saw this last weekend. So Doug put it on the screen. Yes, the Bengals did actually pull out a win. And it looks like they actually won, and I want to call convincing fashion, but it actually looked like they're on track. So we'll hope that that trend continues. But speaking of rare occurrences, we had a rare occurrence by the Fed, Doug. What happened from the Fed side of the equation here finally?
Yeah, so the long-awaited rate cut has finally arrived. And you can see that this is the first rate cut by the Federal Reserve since the COVID crisis in March of 2020. So quite a long time since we've seen the Fed come in and cut rates. There was some discussion around whether or not they would do 25 basis points or 50 basis points. We did end up getting 0.5%. So the Fed funds rate went from a range of 5.5 to 5.25 down to the 4.85 level. And with it, you also saw money market rates follow that number. So, as a reminder, money market rates will follow the Fed funds rate pretty much to a T, where the actual fixed income market is still based on the participants in the market. So it's not necessarily going to be directly affected by any rate cut, but it will certainly be indirectly affected by how market participants were to interpret that. So we've been talking about this for a while, been waiting for it, and it has finally happened after 4 years. So this chart we had last time, and I think it's really important to continue to emphasize that the speed of the cutting cycle is extremely important. And you can see very clearly on this line, historically, when the Fed has been able to approach their cutting cycles from a slow standpoint. And when we say slow, it's where they're not having to do emergency cuts of 75 basis points or 1%, where they can, even if they're doing 50 basis points, maybe they're not doing it every meeting. Maybe it's a total of 2% over a 12-month time period, but they're not necessarily forced to go in and be aggressive based on some kind of economic or market emergency. And right now, granted, we've only had one rate cut, so it's hard to determine this for sure, but we're hoping we get a slow cycle to allow that soft landing. And ultimately, that soft landing has been very beneficial to markets, as we can see here. So let me pull up my laser pointer briefly. So this kind of navy blue line here represents the slow cutting cycle from a historical basis. This first dotted line would be the first rate cut. You have 12 months prior, you have 12 months after to this line, and then you have another 12 months after that to 2 years. So you can see slow rate cuts, very beneficial to the market. Fast rate cuts, not so much. So going forward, the speed of this easing cycle is going to determine what is next for markets overall. Now, we've talked also about the yield curve. We've talked about the inversion of the yield curve, which is essentially when short rates are trading at levels that are above longer rates. And you hear a lot about, inverted yield curves lead to recessions. And that's not necessarily true. It's actually when the curve uninverts aggressively is when recession usually takes place. So this chart goes back to 1985 and it shows two separate yield curves on it. You have the 2-year, 10-year treasury in gray, and then you have the 3-month, 10-year in blue. And then these vertical gray bars represent periods of recession. And it is pretty clear to see that as you have inversions and then steep or re-steepening aggressively, that is when recessions have hit historically. So early 90s, 2000, 2007, we'll call the COVID crisis a recession, even though I would completely throw it out because it's an outlier for many reasons. But here we have, again, a deep inversion that lasted quite a while, and you're starting to see a re-steepening of the yield curve. Now, we're certainly not to levels from a spread perspective that would indicate that we're going into or imminently in a recession right now. But this is certainly something to pay attention to going forward, because it will give us some idea on whether or not the economy is moving in the right direction. Now, based on the yield curve, what have yields actually done, not only this year, but I would say since the rate cut? So as we look on a year-to-date basis, we had yields peak right around the beginning of May, bottom out, roughly right around the time of the rate cut, and then surprisingly, yields have gone up since we've cut rates. So you can see here that the 30-year bond is right around 4.15. And then you have the 2-year at 3.61, the 10-year at 3.79. So when we talk about yield curves, inversions, and steepness, we would say that the yield curve right now is about 18 basis points steep, which again is not anywhere near what you historically see, where you're getting 1.5%, 2% steep. But the process is starting. But somewhat surprisingly, yields have moved up since we've cut rates. So still a long way to go in this process, but it's just getting started. Now, on the equity side, I'm seeing a lot of comparisons to some of the more ugly market cycles, specifically 2007 and 2000. And full and fair disclosure, there are some similarities, but there's also some significant differences. And this chart, I think, lays one of those differences out pretty clearly. So historically, when the Fed has cut rates near all-time highs, it's been very beneficial for the stock market. So you look going back to 1980, all of these green dots that are on this line represent times when the Fed cut within 2% of all-time highs. Now, where do you not see these green dots? You don't see it anywhere near 2000, and you don't see it anywhere near 2007. Every instance has been in a time where you've seen a pretty positive market. And if we look at the actual numbers that back it up, 6 months out, the median return has been 6%. And you've had positive occurrences roughly 75% of the time. And then 12 months out after this has happened, you've had a median return of 10, an average of 14, and you've had 20 instances and 100% success rate when the market's been up a year after this has taken place. So, as you're hearing a lot of comparisons, and I think sometimes we incorrectly think of markets in this very extreme binary manner where a market either has to crash or it has to rip higher. There definitely lives a world in between that. And I think this chart, supports the idea that, stocks can still move higher through not only the end of the year, but into 2025 as well. Another kind of rare occurrence here is that the Fed rarely cuts rates into an earnings recovery cycle. So there's kind of a lot going on in this chart. The two places I think, I want you to focus your attention are the two red circles. So the first one being, 1998. So you had, in June of that year, you had the beginning of a very short cutting cycle. but it was right at the beginning of an earnings growth expansion, so to speak. So we all know what happened in 2000, but what we may not realize is from the time that the Fed cut here to the top of this market, the S&P rallied 41.5% before the very top of the tech bubble. Now, you're seeing a similar situation right now, whereas they're starting their rate cutting cycle, and you're also seeing earnings growth expectations rising. So, interesting in the sense that if you're looking for a soft landing, this is probably a good sign because, again, they're not going to, at least based on the data we have now, they're not going to have to go in and aggressively start cutting rates to battle some kind of economic emergency. Historically, what we've seen post-rate cut from different parts of the market, both 3 and 12 months afterwards, have been pretty positive. So the bottom rung one here is a Russell 2000, which represents small cap. So, a pretty muted 3-month return for all of these, but 5% 12 months out for small cap. You have around 10 average for the S&P 500, and then mid caps actually is the winner here, right around 13.5%. I think the challenging thing here is that the valuation from large cap relative to mid cap and then relative to small cap is at some pretty extreme levels. So from a valuation standpoint, small cap and mid cap actually look probably the most favorable from that perspective. So it'll be interesting to see if these patterns continue to play out after this, because I think that'll dictate a lot of where the performance will lie and where HCM as a firm may make some tactical adjustments in equity portfolios. And then, from an equity performance standpoint, since the rate cut, surprisingly, the big winner has been emerging markets and international to a certain extent. Now, a lot of the emerging market story has to do with the announcement of a large stimulus package from China, but in a very short time frame, emerging markets are up almost 8.5%. International up roughly 3%. You have the S&P up, respectable 1.29, mid caps up 85. You actually have small caps down 1.26%. So small caps can continue to struggle. And, for all the tailwinds that they have right now, they're still just really having trouble finding traction. So, outside of those areas, I think we are seeing some things underneath the surface that are interesting and that I think would continue to support the idea that markets can continue to move higher. So, Dan, you're looking very sharp in your new HCM vest there. So I can't wait to hear what you have to say about this.
Yeah. So in the last webinar, we talked a little bit about the market pullback, the 9 to 10% pullback that we saw, and we kept reiterating that there wasn't much breadth damage under the surface. You didn't really see anything really deteriorating. And after we got that pullback, we really saw September show us that not much was damaged. So breadth in Q3 was very, very strong. The S&P in Q3 throughout the whole entire third quarter returned 5.4%. But the average stock in the S&P 500 returned 9.2%. Only 109 stocks were negative, which is, a very historically low number, or a very low number to see with quarterly and annually. So you did see all of these names that were somewhat neglected with kind of the NVIDIA push and the mega cap push start to really drive the S&P 500 forward, and it really led to a very strong month. Now September historically, if you want to go to the next slide, is a pretty weak month. We have election years, and all years on this chart here, all years on the S&P 500 are in blue and the election years are in yellow. And in both instances, you can see that September is typically a negative month. So to see that much strength come out of the September month, it definitely shows that there are some strength below the surface within the S&P 500 constituents. Now, NVIDIA went sideways and even corrected a little bit, but the S&P still chugged on because the rest of the members that had been neglected really pushed it forward. So honestly, positive monthly returns in September are pretty rare, and it put a pretty solid third quarter in for us. To show you a little bit of how rare it is. So this chart shows the S&P 500 frequency of all-time highs by month. So we hit an all-time high in September, and as you see on this chart, it's the lowest month here. The number is 5.9, so that means on average, a new all-time high gets hit in September 5.9% of the time. So that's a pretty low number, and we had a lot of uncertainty. We have the election coming up. We have we have the Fed rate cuts. There were a lot of things, a lot of uncertainty, but the market just continued to push forward on very strong fundamentals. The breadth really expanded, and the market is looking pretty healthy top to bottom at this point. So to touch a little bit on the election cycle. So election years are a little bit different than all every other years. We know that we've tracked this election cycle pretty closely. This chart kind of shows a composite, the current S&P 500 performance for this election year compared to every election year in blue, the last 10 election years, so 40 years, and then the last 5 cycles, which is 20. As you can see, a rally through the first half of the year is not super uncommon. Second quarter, third quarter, always pretty strong. Getting into the fourth quarter, you definitely see some volatility. A lot of people were expecting September to be the time period where things started to roll over if you're just looking at historical numbers. But the S&P 500 had other plans, and the market continued rolling. So we know through history that October, November are pretty weak months. So we definitely expect some volatility on the election uncertainty, the Fed rate cuts. Now we're mixing in a port strike, and now we're mixing in Middle East. So there's going to be a lot of uncertainty. We would expect maybe a little bit of volatility, but even in all those instances, through the volatility of October and November, a lot of those, or pretty much all of those periods, you still see a pretty strong rally as soon as the election uncertainty is cleared. So when you see November through December, mid-November through December, you see a pretty strong rally as the market kind of looks forward into the new or current presidential regime continuing or changing. Now to go into a Q4 kind of sense. So this year, the S&P 500 has had a really good year, and this chart shows all instances in which the S&P 500 is higher 8 out of 9 months of the year. What does the fourth quarter look like? And it shows the presidential cycles on here too, year 2, year 3, year 4. So there's not many instances in which the S&P 500 is higher 8 of 9 months going into the fourth quarter. As you can see here in the second to right column, the October return, it's hard to really glean some evidence there. There's some down years, there's some relatively flat years, some good years, months. There's some flat months, down months, okay months. But if you look at Q4 as a whole in the far right column, it's positive 100% of the time. Average return 6.6, median return 6.1 for one quarter. So, when we have a strong market going into this year, we're expecting a little bit of, pausing or sideways trading for potentially October. but we see that there's a strong potential that Q4, if we look back through history, is a pretty strong period to be invested. Now, going way too far out in the future, 2025. So the S&P 500 this year has put in a lot of new all-time highs. This chart runs through 9/24/24, and it shows that the S&P 500 has put in 40 new all-time highs. So this chart really breaks down the amount of all-time highs you've hit in a year compared to the next year's performance. So 35 is the highest band. So if the stock market has hit 35 new all-time highs in a year forward looking out, the median return, so the 2025 return, if it returned to the median, would be 5.8%. So if we're looking at what does 2025 look like? Again, there's a lot of uncertainty. There's rate cuts. There's a presidential election. There's all sorts of things on the table for making a way too far ahead prediction. You would look at 2025 and say it would be a positive number, but somewhat muted just based on the amount of all-time highs and the return we've hit so far this year. Now, getting too far ahead of myself, we do have to touch on the election. And Casey was very happy to talk about that. And I'll let him handle all this information.
Thanks, Dan. What a great cartoon. Dan found this for us. And maybe everybody knows, but there are 2 astronauts that launched into space on June 5th this year, and they were expected to be gone for 8 days. And issues came up with the spacecraft after their delay. And now they're going to be coming back in February of 2025. It's almost like the government is running satire commercials similar to the tagline of Southwest Airlines. Want to get away? Yes, get away from the election as far as one can. And these 2 lucky astronauts, they get the prize. So yeah, we're a month away. It's a tight race. The election may come down to 7 swing states. But if you may recall, there was a Democratic strategist, James Carville, coined the phrase, "It's the economy, stupid," which was thought to have helped Bill Clinton win the 1992 election. So speaking of the economy, listed on this next slide, we're going to see are some different policy proposals that could have an impact on the economy. And so let's look at some of the differences between the candidates. As it relates to individual income taxes, Harris would like to partially extend the tax cuts Donald Trump put in place back in 2017 and allow tax cuts to expire for those making over $400,000. Both are on the same page with no taxes on tips. Trump would like to permanently extend the tax cuts he implemented and exempt Social Security from taxes, which is a gripe we hear from many people over the course of time. You mean I got to pay taxes again on that income? As it relates to corporate tax rates, Harris would like to increase taxes while Donald Trump would like to cut the corporate tax rate. Harris would like to increase the small business tax deduction to $50,000 on capital gains tax. Harris would like to increase the capital gains tax rate to 28% for people making greater than $1 million, plus some type of minimum tax for billionaires. On tariffs, both candidates are in favor of tariffs on some degree. Trump would like to have a universal baseline tariff of 10 to 20% and hit China a bit more at 60%. And Harris said she'd like to implement a tariff for electric vehicles from China. So, these economic proposals, they've changed over the last couple months. It's always surprising to see the different policy proposals from the candidates, what they're racing for on the platform that actually get passed. People get worked up on some of these platforms that the candidates run on, and many of which do not get implemented. I wish there was a scorecard that tracked this information. So moving on, who will win? Well, with this slide is to try to give you perspective of based upon how the stock market moves, it might be suggestive of one party over the other. So if there's a big year in the market, the better year in the market tends to align with the incumbent party. And if it's still a good year in the market, maybe a little bit more volatility. It tends to come with the incumbent party losing. If we're looking at this line and looking purely at this line, I guess we would look and say the top line seems like just on movement is more suggestive. We're not saying that's exactly how things are going to play out, but certainly it's been a very good stock market year. We've had very little volatility. But remember, in all cases, if it's an election year, historically, it has tend to be a very, very good year in the market. Now, Dan earlier mentioned next year might be a 5.8% maybe projection when you come to the year after the election. And there's some, reasoning for that. So the reason why typically a good year in the market, years 3 and 4 of the presidential cycle by far the best. It makes sense. If you've got a party in year 1 and year 2 in charge, they're going to try to put in a little bit more of their reforms and things that could sting a little bit. As Dan mentioned, 5.8% may align more with that, where in year 3 and year 4, you want to be a little bit more pro to the economy, pro to the voters, the consumer, because you're trying to get reelected. And historically, that's, I think, why market returns tend to align pretty well in year 3 and year 4. But still, nonetheless, it's been a good year on the market, and the trajectory still looks very, very good. All right, moving on. What combination between the president and Congress provides the best return? And it's the answer that you would probably think it's gridlock. In both cases, when you look at this chart, so whether it's a Democratic president or Republican president, look at the middle column. If you've got a divided Congress, whether it's a 13.6 return or a 13.7, pretty much we're splitting hairs, and a divided Congress really is the way to go. And really it's really going to be based more on the business cycle and what's in process, a little less having to do with Congress and the president. Interestingly enough, the worst combination was a Republican president and having Democrats in charge. So we'll see how these different combinations play out over time, but certainly gridlock appears to be the best one. All right, next slide. Returns based on party. I really like this slide, one, because it goes back a very long period of time. It goes back to the 1940s. You can see that pretty much in almost all terms, the market has had respectable returns regardless of the party that was in charge. But I think the other important part to focus on here is if you look and you see those yellow diamonds or those dots that are on this particular chart, you can see that regardless of what's going on, you have market downturns, drawdowns in the stock market under every president. Now, in some of the terms, the downturns, the market may have been a little bit more skewed, and sometimes it just may be the environment, but the upside can be skewed as well. So I'll give you an example here. So Bush walked into a challenging situation in 2001. Stocks were at high valuations, setting up for more of an extended downturn in the market. Obama steps in near the end of the financial crisis after stocks had already taken a massive hit, where the recovery was just already starting a bit and was underway. And so sometimes a candidate can walk into situations that they had no control over, and they're walking into either a good circumstance or a circumstance that may not be great. Oftentimes, it tends to be a little bit more measured if they've got a longer stay in the White House. And I think you can give a little bit more than, I think, of a real, have they added value from the economic and market perspective. Moving on to the next slide, I think this is probably one of the best messages that one can have is regardless of who is in office, the long-term trend of the market, whether you're a Democrat or Republican that has control, is the trend has been a good market over a very long period of time. And really that's the focus. There's always going to be setbacks. Markets have presented opportunities and risks under both political parties. Yes, elections matter, but it's important you make sure you don't focus them in isolation. The business cycle matters, as do valuations, geopolitics, monetary policy, And the person who occupies the White House is just one of many variables investors should be considering when putting money to work in the stock market. What matters more, economy, profits, inflation, the Fed policy, on how they all line up, not necessarily who is in the White House. All right, this is the next slide is probably one of my favorite slides because oftentimes based upon platform issues, there's often a lot of confusion about how someone depicts a party and what it translates into stock market returns. So here's a great example. Under the Trump administration and the Biden administration, if you look at how energy companies have performed during this period of time, and that's the black line or charcoal line that you see on this particular slide, I think most people would assume that energy companies would do great under the Trump administration and struggle under the Biden administration. And in fact, you've just seen the opposite happen in the course of time here. Energy stocks have done very well during the last 4 years. But the other one is Democrats seem to be more thought in the camp of being more environmentally conscious. And so from that standpoint, people look and say, what does that translate into great stock market returns into organizations that might be associated with global clean energy? And interestingly enough, you have, again, the reverse happening. The Trump administration, global clean energy stocks did very, very well. And during the Biden administration, they have done very poorly. So the narrative does not always align with what exactly happens in the stock market. And it's not just with these two administrations. You can go back to the Clinton administration back in the early 90s when Hillary Clinton was starting to really put healthcare reform and taking a very hard look and looking at potential policy changes. And a lot of healthcare companies were very scared. By the end of Clinton's 8 years, 2 terms, healthcare stocks were some of the best performing areas of the market during that time. So don't focus so much on someone's platform and what should happen because, again, the narrative doesn't always align. It's very, very surprising. It comes back to diversification is still very, very important. We do still pay attention to this and look and say, might there be an area that might be able to participate based upon a candidate? But there are no guarantees with that. So great slide and something I think oftentimes there's a lot of misnomers on candidates and what it may mean for different areas of the stock market. So, all right, gentlemen, let's now move and shift to positioning of our portfolio. So currently we remain overweight equities. We're overweight U.S. large company stocks, and we're looking to trim our profits. You're likely to see that here in the next couple of weeks. We've been overweight for quite some time, both increasing our overweight allocation and then allowing those portfolios to drift as the stock market has done well. Dan mentioned that we may be seeing some volatility, but stocks are getting a little bit long in the tooth. The outlook is still good, but our overweight is getting to be even more overweight, and we may pull and reduce those exposures, but we plan to still continue to keep an overweight equity position. We're still holding a small cash balance at this point in time. Money market rates are still paying a very competitive rate. As it relates to the bond front, we recently increased duration again, so that was reducing our cash that we had. So over time in the last year, we used to have a substantial amount of money market assets as to defend against the Fed and the increasing rate cycle. And as rates have been at high levels, we have over time been periodically then locking out and maturities out in several years out to take advantage of fixed rates of interest to lock those up for the portfolio. And we did that again just recent, and which has brought our cash balance down to a very low level. And from an economic standpoint, with the Fed determining the next moves for cash and stocks, at this stage, Doug shared that slide earlier. and the slide of depending on the Fed's pace on what happens with interest rates. Certainly, the landscape today still looks very good for the economy, but we'll continue to monitor economic data, valuations, the Fed to determine what moves and that may be for adjustments with the portfolio. One that we're watching, we've talked about this before, but again, just to reiterate, is we looked at, and the guys mentioned this earlier, small caps, potentially mid caps. Those may align to be very attractive with the Fed cutting interest rates. So with the Fed cutting rates, it can help out the balance sheets of small company stocks, which could really help the bottom line. Valuations are more attractive, as Dan had mentioned, as well as if we see the economy still have solid footing and look to strengthen, that combination could really bode well for small company stocks and mid company stocks. So we're looking for opportunities. That may be an example of a move that we could make in the portfolio.
Great. Thanks, Casey. Now looking at some question and answer here. So one question that came through was, what would it look like if we saw another January 6th type event? Well, I think there's a lot of ways to look at this, and I'll try to be brief on this. Personally, I think it falls probably into the camp of the debt ceiling, the government shutdown, all of these things that cause the news networks ratings to go up because they can talk about it ad nauseum. But at the end of the day, unless there's a prolonged issue with either the transfer of power, something that prevents that, I'm not sure what effect ultimately that has on corporate America. And corporate America ultimately is the one who are going to generate the returns that are also ultimately going to affect stock prices the most. So I think you would have to see something further than what we saw January 6th. I mean, I'm sure everyone has their opinion on what actually happened. I think at the end of the day, whatever did happen was unsuccessful. But if there was something that was successful in preventing, the transfer of power from whoever's in charge right now to the next president, I think that would have to be prolonged, and probably, I think there would have to be some significant violence attached to it before it had a lasting effect on the market. All of these things have effects on the market in the short term, but to make a permanent issue, I think would take a little bit more. I don't know, Casey, Dan, opinions on that?
So, I mean, I had to look and see the return over the next 6 months after January 6th, and S&P returned like 13%, something like that. But yeah, I mean, I agree. I think you would have to have a situation where people really lose confidence in governing bodies for anything to really affect the market. Riots happen all the time, conflicts happen all the time. If there's nothing that is significantly damaging to democracy in any way, it's all about the economy. So
Yeah, I think it would just fall into the camps that you guys are expressing. It would be a shock event, and like geopolitical events and such, they tend to be temporary. They may have a short-term impact. Could they have a short-term impact on the market? It certainly could. But again, I think back to your guys' point, if it was something that lasted an extended period of time, certainly that could be something that could have a different type of impact. But we can't today, we can't sit here and try to predict something like an event like that happening. I think that we just have to wait and see in the future if we're dealing with something that could have more of a long-lasting impact, as Dan mentioned, to the economy. So an example back in the day in like the early 2000s, during that period of time, you had a recession, you had a rough period of time in the market. and then you had 9/11, and 9/11 then really amplified the environment at that point in time, and it really did then cause caused economic damage, and at that stage it was more extended. So that's probably more of an event that can have an impact. I don't know that we can sit here and try to predict one here, but it was a very short-term related event last time, and from the market, it was a very short-term and a quick reaction.
Another question. So the Fed continues to hold large number of bonds. Do we think that has any effect on the forecast for inflation? So, this is a topic that I think has come up a lot in some form or fashion. The Fed's balance sheet definitely was accelerated significantly during COVID. But as it relates to inflation, and I think probably more importantly, what it does to bond rates at that point. I think the inflation that we saw was kind of the perfect storm of a few different things coming out of COVID. You had a massive, probably the largest fiscal response ever. And you also combine that with a supply chain shutdown to the likes of which we've never seen. So the classic definition of inflation, too much money chasing too few goods, there you go. And I think as that has unwound a little bit, you've seen inflation coming down, and you've seen bond yields slowly moving down as well. Now, the Fed continues to wind down their balance sheet, and they've been reducing that now for, I want to say over a year. Still holding a lot on the balance sheet, but I'm not sure at this point. I'm not sure at this point that the supply of bonds coming onto the market is so overwhelming that it's driving yields higher. And as it relates directly to inflation, yes, there's an indirect relationship there, but if you look at CPI, you look at the core PCE, which is what the Fed pays attention to. Yields don't really factor into that calculation. So for now, I think the inflation forecast is pretty benign. And I think as long as the Fed doesn't have to, throw large supplies of treasuries onto the market, or you're starting to see strings of auctions that are going really poorly, I think those two things can coexist. And those two things being the balance sheet rundown and inflation mitigating itself. I think those two things can continue to coexist together for the time being.
Yeah, kind of the difference between monetary stimulus versus fiscal.
Yeah.
Fiscal have a much more direct impact on inflation that we see every day. Monetary has a lot of asset price inflation, but doesn't really ripple through as much through to bottom line CPI and PCE.
Sure. Okay. So one last thing here, we're going to do, I know there's a way to do a poll in Zoom. I'm not really up to speed on it, so we're going to do a kind of a makeshift poll here. But just out of curiosity on the chat, I'd like to hear comments. Should Pete Rose finally get into the Hall of Fame or not? And we'll give this a few seconds so people can reply and see. I mean, I have a feeling, being in Cincinnati.
So Doug's not a Cincinnati native, so he doesn't really get it,
Yeah. So again, just click on the chat and type in what you think, and I'm curious to see what everybody sees here.
Interesting.
Are you seeing? I haven't seen anything come through yet. So
I've seen two.
Okay. Maybe I have a different chat up.
So it looks like we have some in the negative camp, which I completely understand. But yeah.
I guess Kevin says that they can use the Q&A, but yeah, I see a few. I see heck no. I see it doesn't matter anymore. So surprisingly, some very very old school black and white believers that he has not only got a lifetime ban, but he has as Dan said earlier,
All right, now the yeses are coming in.
a permanent ban.
Yeah, it's still a mixed bag.
Okay, all right. Well, interesting to see everybody's opinion. Yeah, I do like the comment here. It said Pete's ban was a lifetime ban. His lifetime is over, so the ban should be lifted. I think that's a good way of putting it. So, so kind of a mixed bag there, but we're sure sad to see Pete go. A very polarizing figure for the city of Cincinnati for sure. So I think that's all the questions we have. Casey, you can go ahead and finish this up here.
Well, it's been an interesting year. It's been a great year for the market so far. With very little volatility. As Dan mentioned, October sometimes. Don't be surprised if we see some volatility in October as we lead up to the election. That would be normal. The landscape still looks good. Thank you for the trust and confidence you placed in HCM. Please don't hesitate to reach out if you'd like to discuss your individual plan. We're glad to help. And if there's a friend or family member that we can help, please don't hesitate to reach out to provide an introduction. We would be honored. Thank you very much and have a great night.